Well, good morning and welcome to this special edition of our Mortgage Quality and Compliance webinar. My name is Susan Milazzo. I run the California MBA and I'm glad that you could join us today. Today we're going to be talking about some tax implications and everything that those of you in the financial services should be thinking about as we are well into our tax season for the 2020 tax year. But before we get into that, I would like to share that I want to thank our sponsor for our Mortgage Quality and Compliance webinar series. The Compliance Group is a premier nationwide mortgage compliance and quality control organization that serves the financial services industry. All types of financial institutions, mortgage lenders, banks, credit unions, brokers, payday lenders, and consumer finance. And they are committed to helping the industry build a comprehensive internal compliance and enterprise risk management program that will withstand the most arduous of regulatory audits. So if you are interested in more information on the Compliance Group, they are our sponsors for this series this year. And without further delay, I would like to turn it over to our two speakers, Jeff Spiegel with Spiegel Accountancy and
Kristine
Hoeflin with Moss Adams. And with that, I will turn it over to Jeff and Kristine.
All right. Well, thank you for allowing us to be here, Susan. Appreciate that introduction. I'm Kristine Hoeflin, tax partner with Moss Adams. I have the privilege of leading our firm's financial services tax practice, and that means that I have the privilege of working with financial services companies throughout the West Coast. And very happy to be here today. Certainly work with a number of mortgage banking companies that have substantial tax bills this year as a result of how strong the year was. And so that just means that tax planning and tax discussions have been elevated, and happy to be talking about some of the things that we've been sharing with our clients here with all of you today as well. Jeff, to you for an introduction.
Sure, I'm Jeff Spiegel, Spiegel Accountancy. We specialize in the mortgage banking space across the country as well. We're based in California, but have clients across the country. And like Kristine said, taxes are near and dear right now for everybody, and finding ways to try to minimize as best we can in a fantastic 2020 year for everybody. So looking forward to sharing all the information that we've put together.
With that, Susan, if you can help us advance our screen. There we go. Some great bios for you there.
There we go.
In terms of agenda discussion items for you, Jeff and I, as you can see on the screen, have a number of items we're looking forward to sharing. We'll kick things off with proposals both at the federal and the state level in terms of looking at midterm or long-term planning. Then we'll move towards recently enacted legislation and things that you can be acting on at this point in time. And we'll round things out with some multi-state reporting matters. So starting with the current versus potential tax law changes, the slide here on your screen is really a reflection of Biden's tax proposals relative to where we are currently. And when we look at the large tax bills that are going out today, that is certainly a reflection of large earnings relatively in 2020, but it is being benefiting potentially from a relatively low tax rate throughout history. When we look at individual tax rates, for instance, for those of you that are in a structure that is a partnership or an S corporation, 37% tax rate, and many of you taking advantage of a 20% qualified business deduction, you're looking at an effective federal tax rate of 30%. Those in the corporate structure at 21%. And as we look throughout history, those are relatively low rates of taxation over time. When we look to Biden's proposals, some of the key themes that come into play involve those in income levels in excess of 400,000 are considered high net worth. Certainly in the great state of California, we sometimes wish that those were adjusted to cost of living factors, but nonetheless, 400,000 is the threshold that is generally referenced as it comes to the proposals. And so when we look at increases, we do see that the proposals reflect an increase in the individual rate for those at the upper earnings levels, up closer to the 40% rate. We do also see that the qualified business income deduction may phase out for earners over 400,000 as well. And then with that, we would see likewise on the other end of the spectrum, the corporate tax rates would go potentially from 21 to 28%. When you look at likelihoods, if anyone's crystal ball is better than another's, corporate tax rates, that potentially is a low-hanging fruit. It probably would have bipartisan support to get tax rates up from 21% to say 26 to 28%. The reason why that one is considered more likely is because it was being talked about as rates even prior to Trump being in office. And so as we look at the large spending packages that have gone out in recent months, as well as what's being talked about, certainly that would be one area that Congress could readily look to in order to help with some of the spending that is occurring. At the individual levels, those may be more challenging to push through, but certainly the sentiments do seem to be higher income earners have more wherewithal to pay an additional share of taxes. And so you do see that in these proposals. The other item to point out here from an annual tax rate standpoint, long-term capital rates, the second line on this slide is being reflected at a 39.6. The way that's written into the proposal is for those with income over $1 million, potentially capital gains would be subject to ordinary tax rates. That one may have a harder chance of getting through, but that is something that is out there in proposals to be aware of. Estate and gift taxes at the very bottom of this chart. Those are also items that we see a number of our clients looking towards planning around to work within, say, known gifting provisions currently, as opposed to what may change in the future that's a little more out of our control. Moving on from the federal, and I may have gone a little too fast on my slides. Susan, can you help me move back to the state slides? Perfect. So California, similar to federal, is looking at increasing the tax rates, largely focused on higher net worth. As we look throughout the pandemic, they are running at deficit spending in the tens of billions of dollars. So again, looking at where can we come up with dollars to support the spending going out the door. On the screen are a number of the proposals that have been talked about. Some of them have been passed, some of them have not, but we'll go ahead and run through these just to give you an overview of what the thoughts are from a state standpoint of where funds may come from in the coming years. So Prop 15, that is one that you saw on the ballot this past November that did not pass. That would have been one that would bring commercial property taxes up to be assessed closer to fair value as opposed to cost. With that not passing, that does put more of the tax onerous on some of these other areas, such as the wealth tax proposal and income tax increase proposal. So this item 2 and 3 on the list, those were in the legislature this past season. They didn't get done prior to that closing out, which means they need to get put back on the discussion table when the new sessions are in place. But what we saw with the wealth tax proposal was a 0.4% tax on net worth over 30 million or 15 million for married filing joint for those in excess of 30 million of net worth. And so, for example, if you saw a net worth in your a net worth of $50 million and you took the $30 million exemption off the table, a $20 million taxable base would yield 80,000 of additional taxes in a year. Certainly, when I look at our mortgage company clients over the past year, a substantial amount of net worth was built, And so it's not out of the realm for many clients that they would be subject to this tax should it be put into place. So it is one that we will want to keep an eye on as we look into the coming months and year in terms of what the state legislature is doing. Similarly, California income tax proposal to increase annual tax rates. And as this one certainly got a lot of press, but potentially looking at rates when you add a mental health tax in there of upwards of 17% on those in the highest income brackets. And again, depending on how income levels go into the future with the mortgage banking industry, certainly if the income levels were at the current year, we would have seen a number of clients subject to those higher tax rates. So we will keep an eye on those as well. Perhaps providing some relief, the state tax deduction workaround, certainly frustration as it relates to the limitation on state taxes on your Schedule A filings of being only able to deduct $10,000 of taxes. The state of California, knowing their high tax rate, is looking to help mitigate the impacts of that. What they are doing is potentially looking at including an entity level tax on partnership and S-corp returns that then would allow you to take a deduction on the entity level returns. You'd be able to take a federal deduction for those. And then to the extent income is flowed through to the individual level, it wouldn't be subject to tax again. So the effect of what they are working on is to provide you potentially the ability to deduct state taxes as it relates to the business in excess of the $10,000. Prop 19, property tax based on inherited homes. This one did pass. It does have the impact of increasing the tax base for those homes that do get transferred. For instance, if those homes are used as a second home or as a rental property, the property tax base bumps up to the fair value. If they are being used as a primary resident, they do get $1 million exemption, but that does have the potential to raise some taxes there as well for the state. And as we look at all of these items, it does bring about the overall discussion of residency. The overall thought is California continues to be a high tax state. Certainly, there's a lot of perks to living in California, but I will say as we've gone throughout this past year, we've also had more discussions with clients on residency and potentially ways that they can either shift residency to other states where tax rates are lower, or even shift some of their business apportionment out of state. That's a longer term scope discussion than what we have for the hour here, but Jeff and I, we'd be happy to talk to our clients in general about those types of considerations. There's a whole lot of planning that would go into that topic, but certainly something that does make sense to think about in the overall context of tax planning as well as business planning. The Ning Trust, that's another strategy for helping to reduce California taxes. And then the CA AB 85, that is a provision that is out there that essentially limits the use of net operating losses for the next few years for those with taxable income over $1 million, as well as credits in excess of $5 million. And so those are some provisions that have been put in place by the state to help with revenue raising in the short term here. So the planning considerations on the screen, a lot of these are short-term or acute planning that would go into a tax return season. So in addition to the long-term items that we would consider when you look at the overall policies of the federal government as well as the state government and making decisions around long-term tax strategies, these are items that potentially you are able to do on a more quick basis, if you will. For example, the decision of whether to take bonus depreciation so that you can take deductions quickly, or whether you want to save some of those for higher tax rate years. Looking at deferring sales of servicing, certainly we're past 2020 at this point, but that's a determination that you would make on an annual basis. Retirement plans and such come into play in terms of deductions that come through on a recurring basis. And then we do continue to have discussions around, do self-insurance plans make sense? Does it make sense to look at offshoring or changing residency? Does it make sense to look at how 163J impacts come into play and how you might be able to recharacterize things? All of those are good topics for discussion when it comes into planning for your overall tax picture. Here, in terms of looking at timing of tax increases, we had some clients that were anticipating as soon as the White House turned blue that there'd be rates coming through, and they started to increase the taxable income that they were picking up in 2021. I think generally we don't see retroactive rate increases. So as we get further through the year, you start looking further out in terms of when those rate increases might come into play. And that'll give you a sense of, when might it make sense to pull the trigger on trying to pull some income into a taxable year to be subject to lower rates, as opposed to pushing it out to years where you might be subject to higher tax rate, either at the federal or state level. And this slide gives you an idea of a couple of the things that you may want to do there, depending on how we see things go from discussions in Congress. With that, I'll go ahead and turn it on over to Jeff.
All right, so first thing up is our favorite subject, PPP loans. So for those of you, and quite a few of you got PPP loans in round one for sure, that I'm aware of. Quite a few of my mortgage banker clients got these loans. So the first thing was when they originally got the loan, the forgiveness is tax exempt if you get it forgiven. And the IRS came out and said the expenses that you use for the PPP money were not going to be deductible. So in essence, it was going to make the PPP loan taxable when it was forgiven, essentially. In December, when they passed the new tax law that Trump finally signed, I think after Christmas, they established round two as well. They went back in Congress, corrected the deductibility of the expenses. So they said for federal purposes, you still get to deduct the expenses, even though the forgiveness of the PPP will be tax exempt. So in other words, you'll have some free income if you do get this loan forgiven. California does not conform to, and I think there's many states that don't conform, and some states do. I have a list of all the states, but California specifically does not conform. So the expenses are not deductible in California. Now there's a bill on Newsom's desk that would allow up to $150,000 of expenses to be deductible, but that has been dragging on and he still hasn't signed it, and there's no knowing if he's going to or not. So it's kind of causing a hang up in tax returns getting filed, because if you file it and don't deduct the expenses, then he signs it, you got to go back and amend. So we've been kind of extending returns and holding off till a decision's made for people so we can get these returns done right the first time. Let's see, what other things do I want to say? So for forgiveness purposes, I don't have any mortgage banker clients yet that have gotten forgiveness on round one. A lot of them have applied, but it seems like SBA has earmarked the lending industry to look a little harder. So they're asking more questions. I know if you're over 2 million, have a special 3509 form, which you have to fill out, that talks about your financial, your liquidity, and so on and so forth that you have to provide. They're looking at the 14-day sales, because one of the qualifications is you have to have sold all your loans in 14 days. Now, I don't know if that means every loan or majority of loans. It's really hard to interpret. So I'm not sure what the SBA is going to do, but to date, I'm not aware of anybody who's gotten forgiveness yet. So there's a question there as to whether it will. So with that, jumping to GAAP really quick on recording the income, because we're doing a lot of audits, I just thought I'd just divert really quickly. GAAP says you report it as a loan. You can take it to income if it's likely that it's going to be forgiven. So most of our clients are showing it as a loan still because they're not sure if it's going to be forgiven or not. So that's what's going on for round one. PPP round two, they changed the rules a little bit. Round one was 500 employees or less. Round two is 300 employees. They also said in round two, you had to have a 25% or greater reduction in a particular quarter of gross receipts. Comparing that quarter in 20 to 19, you'd have to have that 25% decline to be decreased to qualify for the round two. I'm not sure of anybody in the industry that I know of that has had that decrease and has applied for round two. As far as the use of the funds and the forgiveness and deductibility, I believe is all similar to the round one. Loans are capped at 2 million, so that does limit. Most cases, if you qualify, it's gonna be 2.5 times your monthly payroll. Similar calculations before. There were some exceptions, but not in the mortgage industry. It would be 2.5. Again, I'm not aware of anybody who's gotten round two, and everybody's grumbling about round one, whether it'll get forgiven or not. So that's what's going on for PPP. Good luck with that. So the next item up is employer retention credits. So the employer retention credit came about in the CARES Act, and it's where you could get employment, you can get credit on payroll taxes for employees if you met the criteria for the decrease in your revenues to qualify you or being shut down. That qualified. So it's a way for you to get some tax dollars back, essentially. Having people on payroll, you get tax dollars back to help through the tough times. And so initially for 2020, you had to have you had to either be shut down, government shutdown, or a 50% decline in your gross revenues, gross receipts in a particular quarter, comparing 20 to 19 to qualify. Once you qualified in 2020, if you did qualify, you get up to 50% of qualified wages, up to 10,000 qualified wages per quarter. Yeah, and up to, I think you get it up to, I forget the max, 5,000 per employee, I believe it was, something like that. They also said you couldn't, if you use the payroll for PPP forgiveness, you then, or if you had a PPP loan originally, you could not get the employer retention credit. If you got PPP for payroll, employee retention credit was out. In December, when they passed the next act, they not only extended through June 2021 for the employee retention credit, they retroactively went back to 2020 and said you could get the credit even if you got a PPP loan. You just can't use that payroll for both the PPP loan and the credit. So you would use some payroll for the PPP forgiveness, then the remaining payroll, that if you have any, that qualifies for credit, you could then get employee retention credit. The rules around this are really complicated, so it's not really easy to just say what it is, but it is complicated, and I'm not sure any of the mortgage companies that I'm aware of have been qualifying for the employee retention credit. I have some smaller businesses that are, but that were shut down or really affected, but I don't know anybody in the mortgage space yet that's done this. But the new act extended this to June in 2021, increased the amount that you get a credit for to 70% of the 10,000. So you can get up to, for 2 quarters, up to 14,000 per employee in 2021. The decline in your gross receipts only has to be 20% as opposed to 50% like it was in 2020. Again, you guys are having great years, so I'm really not expecting you to qualify this, but if you think you might, really good to look at it to see if there might be an opportunity to get some payroll tax money back. And so I think with that, do we have anything else on retention? There we go.
Perfect. So I'll just piggyback off of what Jeff was saying with the mortgage banking industry. Again, we haven't seen many, but the reason Jeff and I said, let's keep these slides in here, let's talk about it, is most of our clients are at least asking the question. And that's what you should be doing, is are there dollars out there we can take advantage of? Let's ask the question. And so again, we did want to make sure that you were educated on it, because I imagine you would want to ask that question. Are there dollars we're not taking advantage of?
And in addition, you may have other businesses that you have your mortgage company, but you may have other businesses whether it's, you know, real estate related, but you could have a restaurant or you could have many other businesses that this might qualify you for. So
For sure. So taking a look at the extenders that have come through, these items are, let's see here if I can get the slide in the right place here. Just give me one moment. Tax extenders and updates. These are items that were made permanent through some of the acts that were passed towards the end of the year. The item to point out on this page is once we start to see things more open, there is 100% deduction on business meals, including delivery and carry out from 2021 and 2022. So once you get all your mortgage bankers out and doing their lunch meetings and growing the practice, you'll be able to take advantage of that, set up a new GL code to take that additional deduction, and a few other items on here to be aware of. In terms of extenders that also came through some of the year-end acts, a couple items to point out here. The new markets credits for those that I have seen those in some of our financial services companies that have mortgage banking arms. So that is an item that has been extended through 2025, as well as potentially, but hopefully not used. We've got a discharge of qualified principal residence indebtedness was extended as well, although the exclusion amount is reduced. So that item is notable here on this slide.
and that one's a federal, right? Federal.
Federal.
Not a California.
Right. Again, on the federal extenders, the treatment of mortgage insurance premiums as qualified residence interest was extended through 2021. So that holds as well as a collection of other items here on your slide deck as well. Research and development credits. The item to be aware of here is more and more of our clients are talking about innovation spend, setting aside dollars for innovation spend. And so then following that discussion is, are there R&D credits available? And what do they look like? And how do we know if we qualify? And so certainly that has been an item that has been talked about more in recent years. The key when you're thinking about whether your costs qualify is, are you spending your money on a plug and play software? Are you buying something in the market and plugging it into your core and it works? Or are you going through an innovative process where there's a level of uncertainty? You're doing research, solving an uncertain problem to come up with your mobile banking app or to come up with a new process of automation. Those are the kinds of things that are significant from a research credit standpoint, is understanding, is there uncertainty? Is there a iterative process that's going into play? Those are key when it comes to seeing whether the costs that you're incurring may have the ability to qualify. The types of costs that would go into a credit would be the wages paid to your employees for qualified services, supplies that you may consume, contract research expenses. If you're involving an educational facility, costs going in there. And I will say that we have seen more able to claim these credits in recent years than we have, say, 5 or 10 years past. I would say more in the recent 5 years, and as well as clients that are coming to us saying, here's what we're planning to do over the next 2 or 3 or 4 years. How would that come into play? And so an item to keep your eyes on, make sure you're bringing it up to your tax service providers. Certainly nice to get some extra credits here for things that you're doing that is promoted by both the federal and state governments.
Okay, depreciation, our favorite subject. Fast deductions. So as most of you I'm sure aware at this point, bonus depreciation exists for property placed in service or trade or business. So right now, from a federal perspective, you get 100% bonus depreciation, meaning you get to depreciate 100% in the year of acquisition on most property and equipment. That's going to go through 2022, and then it's going to start to phase down 20% per year. So it'll go to 80, 60, 40, and expire in 2026, unless there's a change in the tax code, of course, that Biden pushes something that's going to change this. Jumping in really quick on this, though, is there's a de minimis rule that I want to make you aware of in capitalization policy. So for tax purposes, we're always electing a de minimis rule, de minimis on the tax. You'll see an election on your tax return. The reason being is if you don't make that election, you have to capitalize items of $250, over $250 and depreciate them. So you have to go through them tracking and take a bonus and so on. If you elect de minimis, you can jump to $2,500. And if you have an audited financial statement, you can actually go to $5,000 as your cutoff limit. So since most of you have audits because of your audit financial statements, because of your warehouse, HUD, Fannie, Jenny, and all that, you're allowed to set your capitalization policy at $5,000. So that means any individual item you buy for less than $5,000 goes straight to expenses, supplies, or equipment purchase category, whatever you want to put in your P&L, and not have to be tracked in your depreciation schedule, depreciated, so on, and so on and so on. So good idea to make sure you bumped up your policy so that you can, you know, take advantage of the de minimis rules. But if not, you're going to get the 100% bonus. Not all states conform on the bonus. Some do. California specifically does not have bonus, so you're going to have to depreciate that over time. You do get the Section 179 in California for $25,000. Everything else gets depreciated over time. So the qualification for bonus is property with a 20-year life. It does not have to be original use. It can be used property as well. The qualified leasehold property, when the tax law came out, I guess it was in end of 17, they inadvertently messed up and didn't have the qualified leasehold in there for the 15-year, allowing it to be eligible for bonus depreciation. So you had to depreciate that over a period of time. So they subsequently have fixed that in the tax bill last year. So you could consider going, if you had that, go back and amend and get the accelerated depreciation if you'd like to do that. Going forward, it's all qualified for the bonus depreciation. As far as the placed in it being in service, obviously it has to be ready and available. And for any kind of leasehold, it has to have a certificate of occupancy or to be placed in service. So there's your bonus depreciation. So to accelerate things, you know, obviously buy things that in advance to get the depreciation if you're looking for deductions. Buy only if you need it. I found that the bonus depreciation comes in really good if you bought, some clients, since they made so much money, bought, you know, airplane. So they're using their own airplane as opposed to commercial. You get into personal use issues there, but you have to be careful. But there can be some big accelerated depreciation, things like that. Anyway, so then the next item is for those of you that are LLCs and file as partnerships. The IRS came out with a notice that's requiring all of the partnerships to report their K1 equity on a tax basis, not a GAAP basis. I think most often we'd have a GAAP basis on the K1 where the equity section is, and then the K1 numbers would be on a tax basis. And so now they're requiring us to adjust the K1 to be on a tax basis. So you're going to see a change in this K, and there's going to be disclosure that it's changed, maybe how much it's changed, and so on and so forth. So it's kind of a hassle for us tax people, because unless you're tracking tax basis, we got to go back and figure out what tax basis is. Individually on it, each partner should be on their individual tracking tax basis. So hopefully when this gets changed, it's going to match that basis. If it's not being tracked, well, then you got to hope that the numbers that come through are right. But anyway, they're allowing you to do 3 different methods of adjustment. Modified outside basis method. So sometimes it's hard to explain because it's really complicated, but there's inside basis and outside basis. Inside basis is your basis of the partnership, looking at the books of the partnership itself. But many times there's outside basis, because if I buy some shares from somebody else at a higher price, that might not get reflected inside the partnership, and I might have some basis that I paid in excess outside, and I need to track that. So one method is to actually track that inside the partnership basis. Probably not a method that's going to be used very often. The second one is a modified previously tax capital method. And that one's probably not going to be used much either, because you're tracking your tax bases inside the partnership, but then you have to hypothetically look at, if you sell the partnership, what that gain would be, and include that into the partnership basis. Probably not going to happen. Moving forward. All right. The last one is transactional approach, which is probably the most common that's going to be used, and that's basically your capital account is your contributions in, your income increases it, your distributions decrease it to your ending capital, and that's more likely than not the method that most everybody's going to do the best to do. The section on the K1 is this section L is the one that's going to change. So if you look at your K1 last year to your K1 this year with that beginning capital account, the beginning number will not be the same as your ending from the prior year. It'll be on a tax basis if it's not on a tax basis already. And there should be disclosure on the K1 kind of describing it and maybe even quantifying that change. The other thing is the rules call for you to take your best approach to this that you can. They're not like looking at, they're allowing you, that's maybe not be perfect, because it's a very challenging task. So they say do the best that you can to do this, and then that you can't get penalized. If you don't do this and do stay on GAAP, then they can charge you a penalty, and the penalty was steep. I wanted to say it's like $210 per partner per month for a maximum of 12 months. So the number can be really huge. So you got to make sure that this is at least attempted and taken care of, because it could have some significant penalty effect if you don't do it. I'm sure that most of the tax firms out there that are working with LLCs that are mortgage companies are addressing this and getting this thing at least as right as possible. But make sure that you're aware of that. And on to states. Oh, I'm going back to the K1 really quick before you jump in there. The state does not conform, so I'm finding federal, you have to go to tax basis. California requires you to stay on the method that you use for your books. So technically, California would stay on a GAAP basis and not change. Makes it really challenging in the tax software, I'll tell you that. And I don't know that you have, if you do end up changing both, I'm not sure that California is going to have an issue with that particularly, but their rule does say book basis, just an FYI.
All good stuff to be aware. So moving into state reporting. So certainly this year with our mobile workforce and people working from just about anywhere, we've had a number of questions from our clients in terms of what does that mean from a state tax compliance standpoint. And so there's a handful of ways that this comes into play. First, if you do have employees that are working out of their general place of residence, they've moved in the meantime, you are looking at trying to understand whether there's additional payroll tax obligations as well as income tax filing obligations. And for a period of time, Congress had on their docket discussions related to making something a little bit more uniform in terms of speaking to how long people could potentially live in another place during this COVID realm and have some protection around nexus. That hasn't moved forward. They've got plenty of things that they're working on that hasn't seemed to make it to the top of the list. And so it really is a state by state assessment, as well as just a decision making on the part of companies' management to determine where filings will make sense. Some companies will set their own internal policies. Are individuals there intending to be there permanently? Are they there more than 30 days? And using different thresholds to determine for themselves where they may be determining that they need to start filing payroll taxes or start filing in other states. But otherwise, it is a state-by-state analysis, and happy to help look into the rules there. The other piece that's been coming into play from a state standpoint is just with base federal taxable income higher. That then means that when you apply those relatively small state apportionment factors in certain jurisdictions, all of a sudden the numbers are quite a bit bigger this year. And so that has meant for many taxpayers that they are looking at filing in more states than they have previously because the liabilities and exposure there is higher. And so that is certainly increasing the complexity of state compliance coming through this 2020 tax year. And Jeff, I'm sure you would agree, you're filing in quite a few states this year and seeing quite a bit of substantial checks going out the door.
Yep.
What Wayfair brought about, that was a sales tax specific case ruling, but it did bring about a general threshold of $100,000 of income. Again, that's sales tax related, but some companies have used that as a good gauge for when they would start then filing in state jurisdictions. Not hard, fast rule, but a rule of thumb that some have been looking to, and that's what's referenced here on this slide as well. Looking to the just overall landscape of state taxes, what you see on this slide is essentially the state tax rates across our nation. And certainly in the great state of California, you're seeing darker purple reflective of the higher tax rates there. As mentioned earlier, there have been increasing discussions of whether the movement out of the state of California would make sense for a selection of employees. Certainly you don't want to have the tax tail wag the dog. There's obviously a lot of trained employees in California that are serving businesses well. But with that, we have had more clients asking the discussion of what would be the impact if we have an employee and if we have a set of employees in Oregon or Nevada or Arizona. And so some of what you're seeing is there are potentially rules that would increase payroll tax filing exposure. So you do want to be mindful of whether the state you're going into has income tax for those employees. You do want to be mindful of how it would change the apportionment factors. Do they have an income tax filing, or are they like Nevada or Washington where there isn't an income tax filing, but maybe some other filings that would need to be done? Oftentimes you do end up having the ability to pull amounts out of your California apportionment, but there are some quirky rules that may throw income back into California. So there's some rules there to be mindful of. But all of that is to say that there can be some mapping of what would happen from a bigger picture tax planning standpoint if you were to make a shift in where pools of employees would sit and how that would look to your apportionment, as well as potentially where strategically, if you're doing more lending, how would that change your overall picture of taxability?
Can I jump in on one thing on that? So what I get asked a lot, if I move from California to Nevada, can I avoid California tax? Well, and that's the owner of the mortgage company, let's say. So they think they can get out of the California tax. And they can get out of maybe some of it, as Kristine was talking about apportionment to the different states. So if a majority of the loans are made in California, you're still, even if you move to Nevada, you're still going to get taxed in California on the production that was in California. So don't think that you can just move and away all of the California tax goes. It doesn't happen that way. But there are, as she was saying, you can't get rid of some of it because you can work the apportionment factors by doing different things to minimize the California if you do move. If you stay in California, then you're paying California all of it, pretty much, and getting credits from other states that you do pay tax in. So I just wanted
and that's a great point. Thanks for putting that in there, Jeff. And on that point of owners, there is also the discussion of, hey, I'm working towards retirement. How about I just move to Nevada and sell my business? How does that work? And piggybacking off of Jeff's comment, you know, California does watch what you've been doing for the last handful of years and what you're doing over a period of time. And so there is more to that story. To Jeff's comment, there's more to the story of how to move income out of California that does take some thoughtful planning. And the state does look to a broader set of actions. And so if that's something in your future is selling a closely held business or transitioning it, that's a great area to reach out and plan around, because there can be substantial tax savings, but it doesn't come easily, and it also is dependent on a number of factors of consideration.
The other thing on the states, I don't know if you can touch on it because I don't know it really well yet. That state tax deduction workaround you had mentioned, where I'm losing the state tax deduction of my individual that I'm paying, instead of paying the tax personally, you pay it through the S corp or I guess through maybe the LLC, and it get a deduction there somehow. And I haven't read enough to know exactly how that works, but I know that it can work. Do you know enough about it at all?
You bet. So what a good example or a way to illustrate it is right now, if you're a California S corporation and you pay that tax on your S corp, that is a deductible expense on your federal return because it's an entity level tax. And so the idea of the state tax workaround is taking what is right now flowed through to you as an individual tax through your partnership or through your S corp, and actually making it more like that S corp entity level tax. So let's say, for example, California on its S corp and partnership returns will in the future subject you to let's say a 10% tax rate. Then when that income at the entity level would pay $10,000. It's a deduction on a federal return because it's a business tax deduction. And then when that same income flows out to you as individuals, the way that they're looking to draft it is that it wouldn't be subject to a second set of taxation. It would preserve that general single level taxation for flow throughs. So you wouldn't pay tax at the individual level. So you'd have less that would get stuck at that 10%, or excuse me, that $10,000 limitation threshold.
How do you increase the tax at the entity level though?
They'll change the tax rate. Yeah. Okay. So they're looking at putting it on the tax form. So they have a proposal that'll be formal to say, yeah, you can't just say, oh, I think I'll pay 10%.
It's not paying individuals tax through the entity. It's actually, they have to increase the
assessing it
tax, so you get a benefit in the, all right.
Yeah. They'll assess it at the entity so that it's not assessed at the individual level, and that's the issue there.
Right. Perfect. Yeah. Awesome.
Yeah, and then we'll see. Maybe Biden will then have his proposals repeal it, and California will have gone to a lot of work, but we'll see how all these things play out over time.
And Biden does have on his agenda to repeal the limitation on that state tax deduction. He does. So we'll see.
Lots of things to plan around.
Yep.
Well, that does bring us to the end of our prepared slide deck. We're happy to take any questions or turn things back over to you, Susan.
Yeah, thank you both. So much information for everybody. Thank you for putting up the slides there. If you would like to ask Kristine or Jeff any questions offline, here is their contact information. But we do have a few minutes to take questions here. If you have a question for either of our speakers, you can pose it in the questions dialog box on the right-hand side of your screen. While people may be thinking about what their questions are and posing those, I'll watch for those in just a minute. But Jeff, I had a question. You had mentioned when talking about the forgiveness of the PPP loans that in your client base, the mortgage banks no one had received a forgiveness of their PPP loan, their initial one. So are you seeing forgiveness in other industries, or is it isolated, do you think, to the real estate finance industry, or is no one really getting forgiveness yet?
No, there's a lot of forgiveness going on. A lot of my other small businesses have gotten forgiveness. But the mortgage banking business, the SBA has definitely identified that one to look harder at.
Interesting, huh?
So I know there's been correspondence back from some of the banks who did the loans for them, asking for more information.
Yeah.
Asking. There was this new form, of course, but there also was a letter I saw that was asking about meeting the 14-day sale rule and so on and so forth. So I'm not sure because I haven't seen what they specifically are asking, but so far, I don't know any that have been forgiven, where I've gotten a lot of other businesses have gotten forgiven quite quickly, actually. It
Right.
hasn't been a long process.
That's very interesting. That's
So
interesting.
there may be some pushback by the SBA on the industry. There's a question of eligibility, because I know First Tennessee, which is now First Horizon, I'm not sure whether they changed their name. They decided they wouldn't do PPP loans for the industry because they didn't believe that they qualified. But now a lot of other banks did. So anyone who went to them had to go somewhere else. A lot of people got them.
Yeah.
It's just whether they're going to get pushback or not.
Exactly. Such a, gosh, wide variety of reasons, a crazy year for 2020, right?
Yeah.
Let's see, we did get a question here, so let me read this to you. Is California following the federal government with regard to the 2021 tax extension? So if so, would you recommend extending both personally and for a C Corp?
Well, I mean, corporations did not get extended.
It's just the individual.
The S Corps and partnerships were due March 15th, should have been extended already. C Corps were due April 15th. And individuals are what got extended to May 15th on the federal level. California has not conformed yet, so those technically are still due April 15th for California. The other thing is on the Fed, if you extend, you still have to make your first estimate for 2021 in April, not May. So if you owe tax for 2020, it's due May 17th. Your first estimate is still due back on the first date of April 15th for federal. California, everything's April 15th. Still.
Everything's still the same. That's a good question.
They'll just wait till, April 7th. Or
right.
But, for us accountants, it pisses us off, trust me.
Yeah.
Because we're working so hard.
Last minute to demand my time, right?
We're already tired of working all these hours. We want to kind of be able to back off. So it's time to move it. Hurry up.
Okay, well, I think that concludes our questions that we had. So I want to thank everybody for joining us for today's special edition of Mortgage Quality and Compliance webinar series. And Kristine and Jeff, thank you for some fantastic information. We have recorded this webinar and we'll make it available on our website probably in the next day or so. I want to give a quick reminder for we're going to flip back to our regular Mortgage Quality and Compliance webinar series just in 2 days on the 25th. We'll be having a presentation on living with the new IRLA, and Stephanie Delmar with Inspire Home Loans and Scott Weintraub with MQAC are going to be our presenters. And so you are free to join us for that webinar as well. That concludes today's presentation. Thank you for joining us and make it a great day.